Hello everyone, and welcome to this week's Motor Trade Radio podcast. Powered by Motors, the driving force behind multi-site advertising. With Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters.
Well, we'll start this week, Phil, with a few shout-outs because there seems to be a lot happening in the sector at the moment, doesn't there, in terms of events before we even get onto the headlines?
Yeah, I mean, you won't believe we're in kind of a build-up to a bank holiday weekend, and the first of the bank holidays in May. But yeah, as you say there, I mean, this week we've got the AM Awards that have taken place down in London on Thursday evening. So next week we'll have all the winners and the finalists of that, and we'll give a quick shout out and overview of everybody that's managed to win or were nominated and finals for the awards. They're a big event for the AM Awards. And previous to that, predecessor to that is the Driving Digital, isn't it, with the NFDA, which is good old Neil Adley's. He joins NFDA on that every year, whilst everybody's down at the AM Awards. But a great lineup of speakers there as well.
Yeah, definitely. So we'll give a roundup of, as you say, some of the winners next week, and hopefully some of the content from Driving Digital as well. But also this week, Car Dealer announced the launch of Bangers for Ben, their annual driving challenge, which raises funds for Ben. And I mean, this year it looks amazing. It's a 1,500 mile route that goes through mainland Europe and the Alps, which takes place in October. And they reckon it will cover some of the best roads and mountain passes around France and Switzerland. So lots to see there. And Car Dealers run the story, so lots of information how you can sign up for that event, because they are looking really for dealer teams to participate in this.
Yeah, as you say there, they've published a full sort of itinerary for the days. So as you say there, Curtis, the 4 days, and as always, I mean, this event gets better and better every year they do it, and the cars that people come up with, and the artwork and sort of. I don't know what do you call it, Curtis? I mean, they do these cars up phenomenally. I mean, some of you do question whether they'll actually make it around the Alps.
Yes,
I suspect there's always those, but there's a lot of time and investment put into this.
Because I think that a lot of them are cars of a certain vintage as well. So there's no guarantee that they will make the 1,500 miles. And
there's enough people involved that if you do break down, there's somebody to help you out and pick you up.
Yeah, yes. You're in good company, and there will be spanners in cars to do some roadside repairs in fancy dress, because I think pretty much everyone's in fancy dress as well for this.
They do, yeah. They go all out, and I know at the end they usually sort of auction many of the cars as well to raise additional charity funds as well. So I mean, great event, and we'll hear a lot more of this as we get closer to that.
And a shout out for Swans Way. Many thanks for sending details of your latest year ends, which unfortunately came in just after we recorded last week's show. But the full story is certainly on Car Dealer, and this is the full year up to the end of December. And it actually follows on from a conversation we had with the Smythe brothers, doesn't it, Phil?
Yeah. Yeah, I mean, that podcast interview with the three Smythe brothers, I mean, great chat. I mean, how we got through that, Curtis, still amazes me to this day. But a great chat. And actually, that interview that we did with Peter, John and David really gives context to these results, because they did refer to what they were forecasting for the 2023, and they were forecasting a decline in profit year on year. But what they did refer to is the fact that, you know, it was a decline from a very high profit year in 2022. That it wasn't a normal year, very high margins, lack of supply, high demand, So they were expecting a year-on-year decline, and they do add a lot of context behind all of that when we did chat with them on that interview.
Yeah, definitely. So do head over to Car Dealer for the full story there. And also this week we caught up with Lewis Adamson, who is the senior associate of Geldard's, the legal firm, who have really been specialising in discretionary commission arrangements or DCAs, and representing dealers and trying to make sense of the legal ramifications around DCAs and the FCA investigation. So we interviewed Lewis and uploaded that on Friday. So that's actually available in your podcast feed. And we'll also have an extract from that interview on today's pod.
You're listening to all the chatter that matters on the Motor Trade Radio podcast. If you're a supplier and would like us to profile your business and reach our audience of dealer bosses, managers and decision makers on one of our dedicated supplier specials episodes, get in touch with Curtis and Philip at motortraderadio@yahoo.com.
So headlines this week come from Car Dealer, Motor Trader, AM and Business Car, starting with used car price drops halt in April for the first time this year, reports Motors Market View. Cazoo issues business update saying it needs to raise more money to remain viable. New car market forecast to top over 2 million units in 2024, but ZEV mandate could hamper supply, according to the latest forecast from Cox Automotive. A quarter of customers return to dealers for repeat business. North England Lloyd Group acquires family-owned Walkinshaw, and why some fleets are turning to second-hand cars.
You're listening to the Motor Trade Radio podcast, powered by Motors.
We're heading over to motortrader.com, and that's Cazoo issues business update and needs to raise more money. Now, this has come out this week from a announcement overnight in the US, because obviously that's the stock market that Cazoo trades on, and it was kind of an update of where they are and what they're doing next.
Yeah, and the devil is very much in the detail with this story. It was picked up by a lot of the B2B titles. The Motor Trader one sort of leans mostly on the actual statement that Cazoo made to the New York Stock Exchange. But the gist of it is that Cazoo has said it needs to raise more money to remain viable in the medium to long term. And it is also late in filing its accounts. And this is just the latest chapter in the Cazoo story, because they, we reported on this a couple of months ago, the pivot from being an online car retailer to becoming a marketplace. And I think they only launched the new marketplace website over the last week or so. But the Motor Trader story does actually quote the statement at some length, and part of it says that notwithstanding our pivot to a marketplace model and the various asset disposals, we still need to raise additional capital in the future to continue as a going concern in the medium to long term. So that really is signalling where Cazoo is at the moment, and the financial situation that it's actually found itself in.
Yeah, as you say, I mean, the headline kind of says it all. They need cash now, don't they? They need money to move forward with it. It's not a cheap market to be operating in. And as you say, there's a few facets to the business that it still operates. And I think there was reports that some of those, areas had been approached by other businesses, and they've got to decide what they do, what they maintain, do they sell all of it, and things like this. So there's a lot playing out on this, and we don't want to sort of broad brush this as to what is going to happen, because I think we've done this many times on the podcast with the Cazoo story, and we're still talking about it today, aren't we? So there's a lot to play out on this one, I think, still, but we'll keep a close eye on it and share what we can when it becomes available to you.
Yeah, definitely. And I think probably the most telling part of that particular statement is that they do say it is reasonably likely that certain of the company's operating subsidiaries would need to file for administration or liquidation. And it goes on to say we would then consider the best options for the company at that time. And it finishes with the options may include filing for administration or winding up the company. So it's really set its stall out there. So I think the coming days rather than the coming weeks will probably add a bit more to this story.
Definitely. So we've got an exclusive from Motors, which is their market view now. And the headline is that used car price drops halt in April for the first time this year, saying that average used car prices up by 1% month on month in April to 16,964, but that is down 9% year on year. So again, lots of detail in this one, Curtis, from the Motors market view.
Yeah, and I did work with the team on this particular release, so full disclosure there. But the data is actually fascinating because I think the key to this is that the drops that we've seen pretty much through most of last year and certainly since December, they actually halted in April. So is this the way that the market's stabilization that we've been looking for certainly over quite a few months now, and will this see the end to these falls? We won't know until May and onwards, but it's an interesting trend that Motors have identified and picked out. So the increase, that 1% increase that you mentioned there, Phil, it was led by franchise dealers and car supermarkets because they both saw rises in their average prices of 1%, while the average price from independent dealers actually dipped by 1.5%. And the only rises by age were among those 2 to 5 year old and 5 to 10 year old cars, which were both up by 0.3%.
Yeah, and interesting, it talks about the fuel type here, that the increases by fuel type were led by electric vehicles, up 2.5% to 25,905. And that was followed by petrol, that rose 2% up to 16,670, and then followed by diesel up 1% to 15,274. However, hybrids dropped by 2.5% to just over 27,500. However, the overall average prices for all fuel types were down year on year. So again, sort of some telling signs now of what's happening in that fuel sector around the average prices.
Yeah, definitely. And there's a comment from Lucy Tugby, marketing director of Motors, who says average used car prices have been steadily falling since hitting their post-pandemic peak of £18,927 in January 2023. I think sometimes we forget just
Yes.
how high those prices actually reached. But she goes on to say, we're tracking the market closely to see if April's rise is an early sign that some of those monthly declines are halting and whether the market is heading for a period of greater stability. And the cumulative effect of those monthly drops means the average price is now £1,600 below where it was this time last year. So this small rise can be viewed as a correction, though it's worth noting it's still £1,282 higher than those pre-pandemic levels.
That again puts good context to where the market is. Yes, it's declining, but in terms of sort of that pre-pandemic value and the height of the values that they achieved in the post-pandemic market is clear that needs to be put in context for the listeners. But as always, if you head over to the Motors website, the full report is on there. It's downloadable, but there's a lot more detail that it goes into in that report, as always. So it's always great insight for anybody operating in the market to have a look at that, to understand, what's happening, the detail behind it, whether that's by fuel type, make, model, etc., in the market for what motors are seen in the sector.
Next headline is from Car Dealer, and it is new car market forecast to top over 2 million in 2024. But ZEV mandate could hamper supply. So this is based on a forecast issued by yourselves, Philip, at Cox Automotive. This is the quarterly insight report, and the latest forecast is showing that you're looking at 2 million new car registrations this year.
Yeah, I think, on the back of Q1 performance, we know that it rose 10.4% for the first quarter, and we don't expect anything different for the month of April when we get to sites to see those figures there. But clearly, there is big appetite from the OEMs in pushing products into the market, which we've been talking about. But what we're trying to highlight on here is the ZEV mandate now is becoming much more of a conversation within the sector, and particularly at OEM level, as to product coming into the UK market, the challenges that gives some of these OEMs. And I think it was quoted this week by Carlos from Stellantis there that he called out the UK government that the ZEV mandate was making it very challenging for them as an OEM to deal with the UK market, because in addition to the paperwork and in that post-Brexit environment, you're now putting these mandates on to achieve that 22% for cars and 10% for vans in 2024, and that increases for cars to 28% in 2025. When we talked about it, didn't we, recently? We're at 15.4%, I think, for cars at the minute for BEV. So there's a lot of complications appearing now, particularly around the ZEV mandate and what that means for the OEMs. So I think we're still optimistic that we're expecting to see a rise. We expect to break the 2 million bracket this year, which is a good directional trend. But it doesn't come with it comes with challenges. There is still some challenges around the ZEV mandate that's playing out in this, and we'll see how that transitions through the remainder of the year.
Yeah, and it'll be quite a landmark as well, won't it? Because last year the market grew to 1.9 million, but we haven't seen a 2 million market for, you probably know actually, Phil, don't you? But it's certainly back in pre-pandemic times.
Certainly pre-pandemic, yeah. I think that the positive side of this is, the trajectory is right, it's going up. We don't want it to move too quickly because it creates problems in terms of significant oversupply in what we might class as a fairly constrained consumer market, as we've been seeing through private registrations. But again, I think, breaking that 2 million bracket for this year is as you say, a significant milestone for the UK sector.
After the break is our interview with Lewis Adamson, Senior Associate of Geldard, and he'll be sharing his legal perspective on the current furore around DCAs, or discretionary commission arrangements.
You're listening to all the chatter that matters on Motor Trade Radio. Powered by Motors, the driving force behind multi-site advertising. This is your weekly one-stop shop for all the biggest car retailing headlines from across the media, available on demand wherever you are on your podcast feed.
So as I say there, you've been working very closely with dealers, and it's probably more than recent months, but it's very much hit the headlines over recent months on the subject of DCA. Can you start with some of an outline of what DCA is and what prompted the FCA's investigation into the current position of the DCA?
Yeah, of course. So a DCA, discretionary commission arrangement, it's essentially a commission model whereby the lender gives the broker, in this case a dealer, the option to offer credit terms to its customers within a certain range of interest rates. So, for example, the lender says to dealer, you can offer interest rates between 5 and 15%. And the higher the interest rate the finance product ultimately entered into, then the higher the commission will be paid to the dealer by the lender. So that, in effect, is a discretionary commission arrangement. And the FCA investigation is the result of something that's been brewing over the last few years, really. They initially conducted a review of commission arrangements in October 2019. And without going into too much detail, because we could talk about this forever, ultimately, this led to the FCA deciding to ban DCAs from January 2021 onwards. The Consumer Credit Sourcebook rules, or the CONC rules for short, were revised accordingly. And the reason behind this was the FCA rightly said, if discretionary commission arrangements were to remain, then there was an incentive there, in theory, for credit brokers to offer higher interest to increase the commission they will receive. So by banning the DCAs, that incentive was removed. That's not to say, though, that certainly in the case of dealers, just because they'll be paid a higher commission would mean that they'd automatically go for the higher interest rate. It's all a matter of competition and perspective, the deal in the round, so to speak. But we'll get into that later. But the banning of the DCAs from January 21 also happened to coincide and be followed with a Court of Appeal decision in March 2021, with the cases of Wood and Pengelly and Commercial First Limited. Now, these were claims against mortgage brokers rather than dealerships and car retailers. And it was found that, or the law was developed and set by the Court of Appeal, and they found that where there has been a fully secret commission paid, the civil remedies that are available in the circumstances, even without the existence of a fiduciary relationship. And those remedies, as well as the right of rescinding the agreement, also included the right to receive as compensation an amount equal to the commission paid by the lender. So the consequences of this decision and the banning of the DCAs by the FCA seem to lead to a number of claims management companies and some law firms who are looking for the next big thing, really, as PPI claims start to dwindle and phase out. So these claims management companies start looking into the DCAs further. And this really led to a vast number of complaints and county court claims being brought against lenders and retailers alike on the basis that customers were not told that dealerships would be paid a commission, and certainly not that the interest rate would be linked to the commission, and they therefore sought compensation as a result. The compensation being the amount of commission paid plus interest and other damages. The majority of these claims and complaints have been rejected and defended by lenders and retailers involved. And the Financial Ombudsman Service, FOS for short, have also been inundated with numerous complaints on these cases. The FOS themselves have, and which sort of sparked all of this, on 2 occasions reached decisions which were unfavourable to the lender. But there's also been mixed success in the county courts. Some cases were successful, others not. I've been involved in some on behalf of retailers where we have been successful in defending them. I'll come on to this a bit later and Geldard's experience of such claim, but all of this together, mainly due to the large scale and the amount of complaints and claims being made to lenders and retailers, coupled with the lack of clarity as to what the legal position is and what the response by these firms should be and whether there is actually a genuine claim here, has prompted the FCA to step in. And the FCA have decided from January this year to conduct a review using their powers under Section 166 of the Financial Service and Markets Act, which entails the FCA instructing an independent third-party investigator to review historical motor finance commission arrangements and sales across several firms. with the ultimate aim of deciding whether, in the FCA's opinion, there has been widespread misconduct in the use of DCAs. And we should be hearing something from them in September. Whether that remains to be the case, it remains to be seen.
You're listening to the Motor Trade Radio podcast, powered by Motors.
This is a subject that we circle around pretty much most weeks, don't we, on the podcast? There's some mention of DCAs and where we are. But I mean, I don't know about you, Phil, but I found the interview with Lewis Adamson was a real insight into what's actually happening, the legal ramifications, where the FCA is, and the impact of the money-saving expert campaign.
Yeah, I think this is all rumbling around in the background there, but as you say, they're looking at it from a legality perspective, and because it's complicated, it's becoming challenging as you'll see in the complete full interview with Lewis around some of the complexities that are starting to present themselves for the FCA as they investigate this. But fascinating chat there with Lewis, and they say if you do listen to the full interview there with Lewis, it'll be on your podcast feed that we published on Friday morning. It goes into a lot more detail around what's happening, why it's happening, and more importantly, what some of the outcomes could be and the timelines of it.
Yes, yeah, because the key to this is that Lewis and Geldard are working very, very closely with dealers, so they understand the ramifications for dealers and what dealers need to do to just keep on top of what's actually happening. So yeah, do check out the full interview. It's if you've got a bit of spare time over the long bank holiday weekend, it's definitely worth a listen.
Definitely. So heading back to the headlines now and going back over to motortrader.com, and the headline is that a quarter of customers return to dealers for repeat business, and saying that dealer loyalty is still a strong factor for customers when buying new and used cars, and a third of consumers, 38%, rely on a car dealer for advice. 26% go back to do this to the same dealer they have used previously, and that brand loyalty is still a strong factor in car purchasing. And this is according to research from Close Brothers Motor Finance.
Yeah, I mean, it struck me this one, Phil. 25% is that good, or should it be more? I'm sure some listeners will think, no, we do better than that, because
yes, yeah. I think some of them are. I mean, I've heard reports where they get 70% repeat business from customers. That they do put a lot of focus on that, but the market has shifted, hasn't it? So
Yes.
It's. I think it's still good that they're getting a quarter back, but I'm sure some of them are doing a lot better than that.
Yeah, no, definitely. And the story goes on. The research found that a third of drivers, because it's really talking about brand loyalty here, a third of drivers, so 34%, tend to stick with the same manufacturer when choosing their next vehicle, while just over a fifth, 23%, said they usually get the newest version of the same vehicle that they already have, which does kind of make for an easier sell, doesn't it? If you can get someone to upgrade their current car for the latest version.
Yeah, it does. It certainly does. I mean, repeat business is, anybody listening, it's the easiest sale, isn't it? They're fully aware of you as a business, you know them as a customer, etc. So it's the repeat business is the easier option. But there is a quote in here from Lisa Watson, who is the director of sales at Close Brothers Motor Finance, and saying that motor dealers need to know the purchasing preferences of their customers to help inform their stock making decisions, and saying that their figures paint an interesting picture, that they show that drivers are fairly evenly split between those who tend to stay with a single manufacturer, whether that's through loyalty or ease, and those who do not. So it's kind of a good and bad story, this, isn't it? You kind of think that, do you want to do that? Should those percentages ideally be higher? That, this brand loyalty should be higher and dealer repeat business should therefore be higher. But again, just on the podcast, we talk all the time about acquisitions and movement of brands between dealers. They sometimes don't have a choice, do they? If they want to go back to that dealer, but they don't necessarily sell the brand of vehicle that they bought previously.
Exactly. Yeah. And if you are buying locally, that really can be an issue, because it might be a dealership that you've used for years and years, and it's bought out by someone else, is re-franchised, and so interesting stats here, and it'll be interesting to see if there's a follow up to this, several months down the line, to see if that figure goes up at all.
But remaining with dealers, and this is in AM Online, that Lloyd Group adds Volkswagen with Walkinshaw acquisition. And this is the Lloyd's Motor Group has acquired the Cumbrian dealership Walkinshaw. Will see them adding Volkswagen brand to its portfolio while strengthening its market share position with Kia. This is a well-established business up there.
It is, yeah. So Lloyd Group, it operates across the north of England up to the Scottish borders, and represents BMW, Mini, Jaguar, Land Rover, Kia, Volvo, Ineos, and as well as BMW Motorrad motorcycles and Honda motorcycles. So this acquisition strengthens its representation with Kia, and also introduces it to Volkswagen. So this is a really good fit for the business.
Yeah, and you just the AM have put a geographic picture of where Lloyd's are, and they've got some great coverage north of say your border. It's my border as well, Curtis.
Yeah, north of you, that's a long way.
North of me, yeah, but a little bit, yeah, but going up there in terms of that Cumbria up towards Newcastle, etc. So a great coverage, a great expansion from the Lloyd's Motor Group and what they're doing there, and a fantastic acquisition there from a business, a family business of 56 years. We'll be bringing I suspect some great employees, some great talent across with that business, and back to the previous story, I suspect some great brand loyalty as well if you've been in operation for 56 years there.
Yeah, and this really is just the latest in what has really been a succession of some of these smaller acquisitions where standalone sites or small groups are being bought up by neighbouring groups, bigger groups, and we've certainly reported on quite a few just since the beginning of the year, haven't we?
Yeah, we have, and I think we obviously talk about some of the big ones, but there is these smaller ones that are continuing to take place in the background as some of those family business decide to exit the sector, or there is a change of representation from a brand and things like that. And we mustn't forget, these things are taking place behind the scenes very quietly, just these little acquisitions. But like you say, suddenly become a very significant group, don't they? Very quickly, with a few small acquisitions, as we can see there with Lloyd's Motor Group.
And final headline this week is from Business Car, and it is many fleets turning to second-hand cars, Arval finds. So this is research carried out by Arval, major leasing company, that found more than half of UK fleets are buying used car for company use. And it said that data from its 2024 Mobility Observatory study showed that 54% of UK fleets are now actually doing this, with a further 24% planning to do so in the next 3 years. Now, many years ago, Phil, I operated in the fleet sector back in my company car days, and before we recorded today's show, I was saying I've never actually heard of this happening before. These fleets buying used cars, because they always bought new. But this is actually a trend that's evolved over recent years, hasn't it?
Yeah, I think there's a couple of elements with this. Now, through the pandemic, we know that leasing and rental operations were starved of new vehicle supply, because we know that manufacturers switched to retail as the more profitable sales channel for them when productivity was significantly down, and that kind of the leasing and rental companies became sort of knowledgeable then in the used vehicle market, that suddenly there was a potential for that second release of a used vehicle. And also with some of this is some of the manufacturers or some of the leasing companies was, with all the volatility of EVs, that volume coming in a new EV, and then obviously you're moving them into the used vehicle wholesale market and exposed to that volatility of residual values around electric vehicles, that one way to combat that is by putting that vehicle out again, whether it's when it's 2-year-old, 3-year-old, or even 4-year-old, for that second release. So then you are what you'd say is residual value protection or depreciation protection, as you are then getting utilization for that vehicle for longer. So there's a lot of that that's now being built into the strategies for these leasing and contract hire companies. Now, I don't think it's necessarily covered in the story, but some of this may be that as the manufacturers are moving towards that ZEV mandate and their shift to electrified market, be it plug-in hybrid or full battery electric, there's still a demand for company drivers for ICE vehicles. And how do the leasing companies satisfy that when the product isn't necessarily available new? And a way of doing that is by supplying a nearly new or used vehicle to that driver, who's quite happy doing that at a subsidised rate.
And I mean, potentially, this is unwelcome news for dealers, isn't it? Because they will effectively lose these cars that are being recycled within the leasing companies and being put out to fleets as used vehicles, because this is where a lot of the used car stock comes from, defleeted cars that are defleeted through auction and bought by dealers. So, it's a bit of a quandary, this one, for dealers, isn't it?
It is, yeah, because that, the age and mileage profile could shift because the vehicles then come out of leasing older. They might have had 2 or 3 cycles within the leasing company before it becomes into the wholesale sector for the retailers. So that age profile could start to shift, and the type of vehicles entering the wholesale sector starts to shift as well. But clearly, at the minute, there's this balance that if we are going to achieve and continue growing from a 2 million new vehicle market, as we've seen through the first quarter of the year, the fleet and leasing sector is a key component to be able to do that. And that's through new car registration. So there's a fine balance with all of this as to what it will do for the sector going forward. And how high is the demand for that used vehicle on a lease for the company car buyer is going to be the next big question with this.
And amusingly, the stat that jumped out to me in this particular story is that 78% of respondents said these used cars would be used as pool cars. Now, you and I have both worked for companies over the years where there's an unloved pool car or two sitting in the car park. Appreciating.
You need a car. There's a pool car left, and it's just that key that's left on the board, and you go, do I need to go? Do I need that? No, I think it is going to be okay. So I think this has still got to play out, but the dynamics within the leasing companies shifting, how they operate their fleet is clearly shifting, and just by this study, a survey by Havel is identifying that the leasing companies are thinking differently now, how they operate their fleet, and how they sustain it going forward. So, yeah, it's fascinating insight from Abel there on this one.
But that's all for now. So many thanks for joining us on the Motor Trade Radio podcast. Enjoy your bank holiday weekend. And don't forget to check out our interview with Lewis Adamson from Geldard talking about DCAs. But we're back next weekend. Until then, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to the Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising. We'll be sharing all the URLs from this week's headlines on Monday morning. To make sure you receive them, just subscribe to the free newsletter on our LinkedIn page. Just search Motor Trade Radio Podcast.